In today's video, we're going to take a look at one of the most iconic financial bubbles of the early 21st century, the dot-com bubble. Between 2000 and 2002, the world witnessed a massive boom, and equally dramatic bust, in the stock market, centered around the rise of the internet and tech companies. How did this bubble form, what were the key factors that fueled it, and what were the consequences when it eventually burst? Let's explore. The dot-com boom begins in the 1990s. The internet was rapidly becoming a global phenomenon. The World Wide Web was transforming how people connected, communicated, and conducted business. New companies were popping up every day, eager to take advantage of this digital revolution. Investors were excited about the potential of the internet and were pouring money into these new tech ventures. The term .com emerged because many of these companies had the suffix .com in their web addresses. Companies like Amazon, eBay, and Yahoo were among the first to capitalize on the internet's potential. But while the promise of the internet was real, the way investors were betting on it was dangerously speculative. The explosion of tech IPOs as the internet continued to grow, so did the excitement surrounding internet companies. In the late 1990s and early 2000s, we saw a massive surge in tech IPOs, initial public offerings. Companies with no real profits or business models were able to go public and raise millions of dollars simply by having an internet presence. It didn't matter if the company was actually making money, what mattered was growth potential. Investors were betting that the companies of the future would be tech companies, and they were willing to overlook traditional financial metrics like earnings, revenue, or profitability. In fact, it was often the norm for these companies to post huge losses, yet their stock prices soared to unimaginable heights. Companies like Pets.com, Webvan, and Boo.com were all part of this speculative frenzy. The role of venture capital and media hype. Venture capitalists played a major role in fueling the dot-com bubble. Venture capital firms were eager to invest in internet companies, often throwing large sums of money at startups without worrying about whether they would turn a profit anytime soon. The media also played a key role by hyping up internet companies, often portraying them as the future of the economy. The constant media buzz, combined with the fear of missing out, FOMO, pushed even more investors to pour money into these tech stocks, further inflating the bubble. It was an era where anyone with an idea for an online service could attract millions in funding, regardless of whether they had a clear business model or path to profitability. The bubble reaches its peak by the year 2000. The dot-com bubble had reached its peak. Tech stocks were rising at a blistering pace. Investors, fueled by optimism, believed that the internet would fundamentally change the world and create untold wealth. The Nasdaq, which is home to many of these tech companies, was soaring, hitting record highs. At this point, the bubble was so inflated that it seemed as if the good times would never end. But, as we know, bubbles always have a tendency to burst. The crash begins in March 2000. The dot-com bubble began to burst. The first sign of trouble came when investors began to realize that many of these internet companies were never going to turn a profit. Tech stocks started to decline sharply, and the once booming Nasdaq saw its value plummet. Many of the high-flying internet companies that had been trading at sky-high valuations quickly lost most of their value. For example, Pets.com, a company that had raised millions of dollars in its IPO, went from a high of $11 a share to just pennies before it was eventually shut down. The crash hit fast, and it hit hard. Investors who had once believed in the future of these companies were now left with huge losses. The aftermath of the crash. The aftermath of the dot-com crash was felt across the globe. Thousands of internet companies went bankrupt or were forced to scale back. The market value of tech stocks evaporated, and billions of dollars in wealth were lost. Unemployment surged in Silicon Valley, as many tech startups closed their doors and laid off workers. Many of the companies that had once been the darlings of Wall Street were left as cautionary tales of overvaluation and poor business strategy. The Nasdaq, which had peaked at over 5,000 in 2000, eventually fell to below 1,200 by 2002. Key factors behind the dot-com bust. So, what exactly caused the dot-com bubble to burst? Here are some key factors. 1. Overvaluation. Many internet companies were valued at unrealistically high levels despite having little or no revenue or profit. 2. Speculative investment. Investors were driven by hype and speculation, rather than sound financial analysis. 2. They bought stocks based on future potential, not present reality. 3. Lack of business models. A lot of these companies had no clear path to profitability. 3. They were burning through cash without generating any meaningful revenue. 4. Market correction. Eventually, the market corrected itself, and investors realized that not every internet company was going to succeed. 4. The correction led to a dramatic sell-off. The long-term impact of the dot-com bubble. While the dot-com crash was devastating for many, it wasn't the end of the internet economy. In the aftermath, many of the strongest companies survived. Companies like Amazon, eBay, and Google emerged from the wreckage and went on to become major players in the global economy. The crash also led to important changes in the way the stock market valued technology companies. Investors became more cautious, focusing on profitability and sustainable business models rather than hype. The dot-com bubble was a painful lesson in speculative investing and market exuberance, but it also helped shape the tech landscape that we know today. The dot-com bubble of 2000-2002 remains one of the most iconic and instructive events in financial history. It showed us just how easily market optimism can turn into irrational exuberance and how quickly bubbles can burst when reality sets in. But it also highlighted the incredible potential of the internet and digital technologies, which would go on to reshape the world in ways no one could have predicted at the time. What do you think about the dot-com bubble? Do you think we could see another tech bubble in the future? Let us know in the comments. If you enjoyed this video, be sure to like, subscribe, and hit the bell icon for more deep dives into financial history. Thanks for watching, and we'll see you in the next video.